Welcome back. Woolworths has had a few challenging months on the stock market and Rio is poised to instigate a buyback. So how do we play these two stocks? Paul Rickard is the former CEO of Comsec and a star writer at the Switzer Super Report, and he joins us in the studio. Paul, how are you going?
Good, thanks, Peter.
Now, before we just go to Woolies and Rio, which a lot of people hold for obvious reasons, you heard Josh Frydenberg talk about the possibility of discussing first-home buyers getting access to their super. You've always been an advocate of this on our 2GB radio show. You're always talking about it.
I'm a huge fan of this idea for a couple of reasons.
But for a crusty old person like you, it seems so modern. How come?
Well, within reason, and I'll come to a couple of ideas about that. But there are two reasons. First of all, obviously, there's an issue about younger people getting a start in the property market. I think that's number one. But also, I'm a great believer in relevance. And I think one of the big challenges for superannuation is that for people in their 20s and their 30s, superannuation is almost just something that has no... can't quite think of the word, but there's no...
You want a synonym for relevance.
Yeah. And lack of attachment, lack of relevance is a problem because it means people don't care about it, they don't worry about it, they don't hold their fund manager accountable.
They lack empathy with super.
They lack empathy, fees can be what they are. So I think it's a really unhealthy situation having compulsory savings when the person having to force money to superannuation doesn't care about it. So I'm a believer about... Suddenly, superannuation would be relevant to someone in their 20s.
Yeah. Well, I actually wrote about this on the Switzer Daily today, and I thought to myself, see, in our day, we weren't compulsorily forced into super, so we were saving that money. So it was much easier for us to get the deposit saved up because we weren't losing close to 10% of our weekly wage into super. So,
and if a 20-year-old came and saw me at the moment, the last thing I'd say is put money into super. That's the dumbest of dumb strategies at age 20 because you're not going to be able to touch it for 40, 45 years if you haven't got your own home.
Okay.
So you need to get that deposit. In the Sydney and Melbourne markets, it's a big gap. And within rules, I'm not suggesting they access all their super. Maybe they access a maximum of half it. Maybe there's some monetary cap. Super fund takes.
And you think bureaucratically it could be actually controlled?
The industry, the super lobby will hate it. Yeah. Anything that upsets
financial institutions wouldn't like it either.
Financial institutions will hate it. The super funds will hate it. Retail, the industry funds will hate it. They'll tell you all the reasons why it can't be done.
Could our Commonwealth Bank shares go down as a consequence of this?
I don't actually think
my viewers be worried about that.
I think the amount of money in play is pretty small, and I think within the right sort of caps, limits, structure with caveats so the super fund gets to partly some interest in the title. When they sell the property, the money goes back into super. I think there's all sorts of good ways that it can be done.
You think it's doable?
I think it's very doable, just a matter of people having a will to want to make it happen.
It's kind of interesting because Joe is actually looking like the nice guy treasurer now. After a year of being the hard bastard who's copped a lot of flack, he's now coming across as the pretty good guy he used to be before the budget changes our view on him. Let's go to Rio. What's the story there with the buyback?
Okay, so they've got they announced back in their half-year results they're buying back $2 billion, US $2 billion worth of shares. Yeah. About $1.5 billion has been done on an on-market buyback. The relevance for Australian shareholders is that $500 million Australia will be done on an off-market buyback. Yeah. There's I think the thing on the screen that closes on 2nd of April. Yeah. And that'll be at an 8% to 14% discount from the then current market price. Now, the thing about an off-market buyback, Peter, is it's a way that the company can effectively return a big franked dividend back to the shareholder. Okay.
See, but a lot of people don't understand this whole buyback bull because, A, they look at it and they say, well, hang on, they're going to pay me less than what I've got in the market, but what's the payoff?
Okay, so the payoff is these off-market buybacks work fabulously well for zero or low tax-paying people. Okay. And they work horribly badly for people who are paying tax at the high marginal rate. Okay. So if you're paying tax, some would say lucky enough to be taxed at 49%, don't even bother to open the booklet, just throw it in the bin. Okay. Okay.
But if you're a retiree on zero tax?
If you're a retiree on a 0% tax, if you're a superannuation fund, either in pension or for that matter accumulation, you should really look pretty hard. And if you're a fund in pension, you're mad if you don't accept. Now, I'll come back to that in a moment. But the reason they do it, Peter, is because they have a surplus of franking credits. Yeah. And it's one way they're able to distribute those. They're worth nothing to the company if they hang on to them. They're obviously worth something to you and I, potential shareholders. Yeah. And the way that they tend to make it a bit more even is they do a few calculations and they work out they don't need to pay as much for the shares in an off-market buyback as they would in an on-market buyback. And that makes it a bit fairer to all the shareholders who don't accept. In this case, somewhere between 8 and 14% cheaper. But yet, for some shareholders, it's still a fabulous deal and they'll accept.
Is there any capital gains tax?
No, in fact, for most people, there's actually a capital gains tax loss because the deemed sale price is going to be a lot less than they own their shares for. So to give you an example...
I feel sorry for some of my viewers trying to work this out, but go on.
Well, it is there in the book, but you read it in the Switzer Super Report, you can see how things... But to give you an example...
Yeah, you'd simplify it. Go on.
A super fund in pension. So this is anywhere SMSF or other fund where there are retirees involved, people taking out a pension. If you were to sell your Rio shares, and let's say the market price was $62, I think today it's actually in the high fives, it dropped down a bit.
Okay, yeah.
Right? The off-market buyback price equivalent for a maximum discount of 14% is $72.12, so that's $10 more than the on-market price. Yeah. And if the discount happens to be 8%, it goes up to about $77.44. So for a super fund in pension, a no-brainer to accept, then to worry about what you do afterwards. Yeah. Super fund and accumulation, you probably should accept. But for
what about transition to retirement people?
Well, they should have their super fund back in a pension being a zero taxpayer, and their fund should accept. Yeah. And, if it's a high-income taxpayers paying 34.5% or 49%, probably just throw it in the offer document into the rubbish bin.
OK. Now, you've written a story on this?
Yeah, you're up to speed, Peter. Good to see.
Yeah, no, but I don't want to be too pushy, but is it Switzer Daily or Switzer Super Report?
That covers it all.
OK, right, good. All right, let's go to Woolies now. Yeah, look, I know you've written this on the Switzer Daily one. That's what got you to come on.
Yeah, a lot of people have Woolworths in their portfolio. Yeah. Look, their recent set of results hasn't been well treated by the market. They're actually down almost this financial year, this calendar year. A couple of things going on at Woolworths. First of all, they're losing the war to Coles, so their supermarket division is struggling.
Goida has done well.
Yeah, has done well, and they've lost now in about the last 12 quarters consecutively. Yeah. And as a result of that, they're also starting to talk about changing their pricing structure. I'll come back to that. Secondly, they've got problems with their Masters, home division, which continues. And thirdly, despite a lot of money, they've done some work on Big W, but who knows whether that's actually going to be able to sell the goods people want. So the main issue is their supermarkets. And
which used to be gold compared to Coles, weren't they?
And they still are gold compared to Coles. But what Woolworths has said, look, we've really got our pricing strategy wrong. And we're going to look at a lot of things, a lot of cost initiatives, but by and large, we're going to be a little more aggressive on price. So
prices will be down, prices are down?
Well, that's what's worrying the market. So Woolworths has got one of the most profitable supermarket divisions in the world. Their margin, which is a measure of... sales as a percentage or earnings as a percentage of sales ratio is about 7.43%. Compare that to Coles at about 5.3%. So if they were to get into a bit of a price and start to drop their prices a little bit and reduce their margin, let's say by a whole percent. So Coles is at 5.43%, Woolworths is at 7.4%. Right? Let's say they reduce their margin by 1%. Woolworths has a $50 billion turnover in supermarkets. That's worth $500 million to the bottom line. So that's what the market's worrying about.
And that's what analysts will
How long can they sustain this margin? Now, despite that, you're getting a pretty good dividend yield, almost upwards of getting close to 5%. Yeah. So the market likes that. Yeah. Doesn't think they're going to change the dividend in the short term, but really not a growth stock. So I think the way the market's treating Woolworths at the moment is it'll lag in a market rally, and maybe in the low twos it's got some support for dividend payers.
And every time it gets near 28, everyone buys it because it's a good dividend yield. But it was as high as, what, 36, 37?
Yeah, it did get to about $39 early last year, and a couple of people really liked it.
So is it silly to think that they might get the 33 or 34?
Look, it's probably not out of the question. I think the challenge you have in holding Woolworths in your portfolio is if you think the market can go from, say, 5,800 up to 6,800, let's put on, 10 or 15%. Yeah. I think it's very unlikely Woolworths will go that 15%. Yeah. So I could see it back over $30, but I think it'll find probably support more, and we'll see more of Woolworths with a big figure 2 in front of it than potentially a big figure 3.
OK, great analysis, Paul.
Thanks, Peter.
And it actually is in the Switzer Daily website. I actually saw it. Brilliant article by Paul Rickard. Thanks for joining us, Paul. OK, coming up now is a news hit. We're going to have to see what happened on the markets today with Caroline Herbert.
Good evening. The Australian share market suffered its worst day in more than 2 months today, losing around $24 billion in value as investors positioned for an earlier rise in interest rates in the United States. The ASX 200 lost 77 points or 1.3% to 5,821, while the broader All Ords dipped 76 points or 1.3% to 5,793. The Aussie dollar hit fresh 5-year lows and was buying 76.97 US cents at the close of trade. Job advertisements rose 0.9% in February, according to the latest read by the ANZ Bank. It's the 9th consecutive month of gains. Newspaper ads surged 8.1%, while internet jobs edged up 0.7% on month. Despite the strong read, ANZ still expects the Reserve Bank to cut interest rates at its next meeting. Santos says it has agreed to sell natural gas from its Western Australia operations to Alcoa. The energy company will supply 82 petajoules of natural gas for 5 years, starting from 2018, from the John Brooks field, with an option for 2 5-year contract extensions. Alcoa is one of the biggest gas consumers in the state, where it owns the world's biggest bauxite mine and 3 alumina refineries. Progress on a potential 10-network takeover looks to be slowing, with reports lead bidding group Foxtel and Discovery Communications are losing patience and confidence that a deal can be done. Fairfax reports the ongoing and very public auction has become stressful and distracting for Foxtel's senior management. Despite the concern, it's also reported the lead bidders still believe in the strategic logic of owning the network and will, quote, probably stick around for at least another month. And that's the latest in business news.
Thanks, Carolyn. It's no surprise that mortgage brokers are doing well with interest rates so low and house prices on the rise, and there has been a significant influx of Asian buyers who are adding to pricing pressures. And importantly, the government is moving to impose fees on foreign buyers. To analyse how the housing market is likely to trend this year, we have the CEO of Val Financial, Tim Brown. Hi, Tim. How you going? Just in a nutshell, Val Financial.
Yeah, so VAL's an aggregator. We're similar to Aussie, but the difference is our brokers use their own brand, and we look after all their sort of commissions, compliance, lender agreements, and other products that we help them sell.
Okay. Are you right across the country, or do you have a sort of a predominance in one or two states?
Yeah, very strong in New South Wales, but in every state and capital city of Australia.
And so because you're in New South Wales, you'd have a fairly inside view on what's going on in terms of the Asian buying in Sydney in particular. Is it, how would you describe the strength of it?
Look, you know, for the first time I had some real stats that I hadn't seen before. And a lender who will remain nameless, who lends predominantly in this market, only made up for 7% of our total volume for Asian overseas borrowers. So if you dilute that across our portfolio, it's actually probably less than 3%.
Okay. So that's across the whole country?
Yeah.
Okay.
Yeah, so if you were to bring it back into Sydney, I'd say it could be as high as 15.
Yeah, and that would also be concentrated in a number of areas. They don't want to be everywhere. They're not trying to buy Campbelltown, are they?
No. It tends to be Chatswood, Parramatta, City, and they tend to be very much apartments.
Yeah, okay. How are mortgage brokers doing in this space at the moment compared to banks? During the GFC, the banks really started to have a big stranglehold in the market. The mortgage brokers still did pretty well, but they were getting their money from banks, weren't they, as opposed to other lenders. What's the makeup like nowadays since the GFC? Yeah,
look, the banks are still the 4 majors and their subsidiaries, because they make up another 3. Pretty well, still dominate the market up to about 78% of the volumes.
Yeah.
Brokers now, but account for 51% of all new flows of loans written.
Gee, you threw that 1% to point out that mortgage brokers are now more important than banks.
Exactly.
I noticed the way you did that, yeah.
And what we are seeing is a lot of the retail, the state type banks and the regional banks, and also some of the international banks like Citibank, Macquarie, starting to claw back a little bit of market share.
Yeah. Okay. Now, why have mortgage brokers done so well? And why are the banks happy to play ball with mortgage brokers? Why don't they just say, go get your own money?
Yeah, look, that's a good question and it's asked often. I think The reason being is, from a client's perspective, and it's been pretty well proven that if you go to a broker, you're going to get a better rate than going to your traditional bank, because the bank has a product of the day, and sometimes that may not be a leading rate product. So therefore, by going to a broker, you're going to at least make sure that in this current market, look, if it didn't have a 4 in front of it, you're probably paying too much. So a broker can assure you of that. You know, a lot of the banks will state their standard variable is 5.2, 5.3, but you know in the market people are getting 4.4, 4.3.
Yeah.
You know, there was a fixed rate out by Resi the other day at 4.06 fixed for 3 years on 50% variable and 50% fixed.
Yeah.
I haven't seen rates like that in my lifetime.
It's a pretty attractive product, isn't it? A rate cut, what would it do to markets across the country first, then Sydney?
Look, I think I don't think it would make a lot of difference at this stage. I think they're as low to motivate buyers to want to buy. I don't think that's the issue anymore. I think it's affordability that's starting to come into play.
Okay.
And I think
that just slows the market up, doesn't it?
It does.
A natural retardation of the market.
Yeah. Look, I think yields now are pretty much at their lowest that they've been for a number of years. And I think once yields start to get around 3.2, then people are starting to question whether it's a good investment. Yeah.
Of course, in Sydney, we know there's been an enormous rise after 10 years of pretty well no rises. But in places like WA and Northern Territory, South Australia, they would benefit from a rate cut because their markets aren't on fire at all, are they?
Look, I was in WA only last week, and there are a number of people who are sitting back at this stage. And we've also seen that oversupply of apartments that were built during the good times starting to flood into the market. Vacancy rates are up to 4%. Now, when I went to WA 3 years ago, it was under 1%. So there's no doubt that supply is caught up. And I think some people are sort of sitting back now wondering how much lower can the market go, especially with this oversupply.
What about brokers in the commercial space? Is that growing? Because, you know, everyone thinks mortgage brokers specifically deal with mortgages, but there are mortgage brokers who also get into the commercial side. But are businesses in tune with the fact that there are alternatives than just going to a bank, knocking on the door and say, "Will you give me a loan"?
Look, I think traditionally people, like they used to with residential mortgages, go to their bank first, but we are seeing that cultural shift coming across to commercial now. We've just, in our own business, established a head of commercial, Glenn Mitchell. And already we're seeing an improvement in our numbers simply because we're building that awareness through our broker network. We're saying, look, if you're dealing with a self-employed, there's a strong chance that they're probably not happy with their current commercial arrangements. You should be talking to them about looking at their commercial arrangement and seeing whether you can better that.
Yeah, because the reality is, I think there's just a whole bunch of small business people who don't even know there's the alternatives there.
No, I agree. And we're seeing some unbelievable rates on commercial. You know, 7 and 8% on, you know, residential security. It's just crazy.
So, and comparatively speaking, if you went to a bank, what would you think the rate would be?
If you went to a bank today? Look,
on a commercial loan?
On a commercial loan, they're certainly in the high sixes.
Yeah, high sixes. But mortgage brokers can sometimes get you better, do you think?
Well,
they know the whole range of rates, I presume.
Well, you know, I know in one case in particular recently, $2.5 million on commercial development, and that was at 6.8, and we got that down to 5.4.
Yeah. Now, just you've got a young guy in your system who actually specialises in Chinese buyers.
That's right.
And I met him the other day at a conference. Extraordinary performer, and he's really nailing it, isn't he, by understanding that market.
Yeah, and he's evidence of the Chinese type broker. You know, they work extremely hard, they work long hours, and they've got a huge appetite. And the appetite from China is huge.
Yeah. We won't reveal the figures he did a month. That would be, but they were extraordinary. All right, buddy, great to see you.
Thanks, Ben.
Okay, that's Tim Brown. He's the CEO of Val Financial. After the break, we'll see how investors are getting exposure to the Indian stock market.